This is question number 2 on practice homework 10 for module 14. Quantify the effects of managerial actions on ROPI and components. So we are provided with this very simplified balance sheet and the sales, NOPAT, and NOA numbers for the current year, which is 2017, and the forecasted year. And we're also provided with the WACC, which is the discount rate, right? So compute ROPI for fiscal year 2017 and 2018 net operating assets at June 30, 2016 were this number. Round answers to 1 decimal place. So to calculate ROPI, we know that the formula for ROPI is that it is NOPAT. So it is NOPAT. So let me check my formula here. So it's NOPAT minus the beginning value of NOA times the RW, which is WACC. Beginning value of NOA basically is the previous year's NOA on a balance, which can be calculated from the balance sheet. So given that, let's first copy the numbers, right? Copy all these numbers. So there's some mislocation of this. So I want to add 1 column here because I need the NOA number in the previous year, which is the beginning balance, in order to calculate the ROPI. So we're provided with the previous year's NOA balance is this number. So I just copy it and put it here. So now I can calculate ROPI for these 2 years. ROPI, as we just checked, is NOPAT minus the beginning year, so relative to 2017, the beginning year is 2016, right? And then times WACC. But I don't want to just leave this like this because I want to drag the cell to the right to calculate the 2018 ROPI number automatically. So I need to fix this WACC cell. So I need to add $sign in front of the cell number. So then I can just pull the cell to the right. And I have to check the rounding requirement. It asks me to round answers to 1 decimal place. So I can just use round function to achieve that. So just 1, and then I can pull the cell again. So this turns out to be 11.0. So now I can just copy the number back. So part B, the company is contemplating taking the following actions before the end of June 2017. These actions are not reflected in any of the financial data reported above. So for each of the actions, determine the effect on residual operating income for the fiscal year ended June 30, 2018. So we are given 4 different types of actions. And if you look at the table, here also for each of the actions 1, 2, 3, 4, we need to calculate NOPAT, and this is for 2018, right, for the forecasted year, and NOA beginning year. So that means we need to input the number for NOA for 2017, right, in the middle cell, and ROPI is calculated based on NOPAT and the beginning year NOA and the WACC. So for the actual number June NOPAT, we can just copy the number here, right? It's just directly provided. And forecasted, this is also directly provided. and NOA beginning relative to 2017, that's the 2016 number. So we just need to copy this number here. And for 2018, it's the level at 2017. So we need to copy number here. And for our ROPI, we just calculate those two numbers. So just copy them back again. So now we just need to worry about this. For each action, worry about each of the three cells. So for action 1, it's a reduce inventory by 10%, which reduces accounts payable by 5%. Since inventory and accounts payable are all part of the NOA, right? NOA is operating assets minus operating liabilities. So inventory is part of operating asset and accounts payable is part of the operating liabilities. So the changes in these two variables will impact the NOA level. So how does that specifically impact? We can just copy the balance sheet and do a calculation, right? To do that, we first mark all the operating assets and operating liabilities in red. So we know which items we want to operate, right? So accounts receivable, inventory, and PPE, they are all operating assets, and accounts payable is the only operating liabilities. And cash, long-term debt, they are not operation related. So now this is the original balance sheet. Now I just want to copy this and make this number to be 1, so I know this is actually for the first action. Right? If you look back to the first action, it is reduce the inventory by 10%, which reduces accounts payable by 5%. So we need to change the inventory balance here equals original level times 1 minus 10%, right? That's according to the setup. And then we also have to change this accounts payable. So this equals the original level and then times 1 minus 5%, right? So that's based on the information provided. So now I can do a calculation for the NOA. So NOA is basically the sum of the operating assets minus the sum of the operating liabilities. So I can just sum up the 3 operating assets starting from accounts receivable, and then I subtract the accounts payable, and that is my new NOA. Remember, these actions are taken at 2017. So here we are needed to input the numbers for 2018. So relative to 2018, 2017 is the beginning balance for the NOA. So that's why here, actually we need to put the 1465 numbers as the new beginning balance of NOA for action 1. But these actions shouldn't impact NOPAT, right? So we can just leave the same number as before, which is 216, and then ROPI. How do I calculate ROPI? I can calculate ROPI simply by changing the number here, because basically what's changing, the only change we have so far is the change on the NOA balance at 2017. So I can just net this balance equal to the new number here. So you can see that this number will automatically change, be it 113.5. So that is my new level for the ROPI. So we're done with action 1. For action 2, decrease property, plant, and equipment PPE by 20% with no consequent impact on NOPAT. So then we can do the same. Just copy first copy the balance sheet. But remember, we are doing the action 2 now, so we just put a 2 here And then this change here is to change the PPE, right? Decrease the PPE by 20%. So I need to put the original level of the PPE and then times 1 minus 20% of that. So then the new NOA balance is simply the sum of the 3 items here, operating assets, and then subtract the accounts payable. So this is my new NOA, and this is my beginning balance relative to 2018. And also there's no impact on NOPAT, so I just put the same level here. Again, to get the new level of the ROPI, I can just net this number, right? Just change the NOA for 2017 number to be equal to the new level here. So, and then this ROPI will automatically be calculated to this new level, and then I just copy the number back. So that is action 2. Action 3, engage in a sale leaseback of a major building. The company will sell 50% of its PPE at book value and increase rental cost by $30 after tax. So this will impact both NOPAT and beginning balance of NOA, because the change in PPE will impact NOA, and the change in the rental cost, the increase in the rental cost will decrease the NOPAT, right? Net operating profit after tax. So the rental cost is sort of part of the, either could be cost of sales or the selling, general and administrative expenses. Whichever we put this cost in, it doesn't affect NOPAT, right? The NOPAT will decrease by this same amount, $30. So then we can just, again, we just first copy the balance sheet here, and then the change we'll do, because the book we actually sold 50% of the PPE, so the remaining balance is only 1/2 of 1,000. So that is the new remaining balance, and then we just need to calculate the new level of the NOA. So, and then put this number here. And for NOPAT, as we said, it should be the original level and then minus this $30. Right? If you check the, I guess that's in chapter, that's in module 3, right? If you check the module 3 lecture slides, you will find out the formula to calculate NOPAT is net operating profit before tax minus tax on operating profit. And tax on operating profit is tax expense plus pre-tax net non-operating expense times the statutory tax rate. Because the only change on the income statement based on this action is the change in the rental cost. But the rental cost doesn't affect anything in the tax on operating profit part. So it will only impact the net operating profit before tax, and that's basically most of the time is just the operating income. And rental cost is part of the expense we need to deduct in order to reach the operating income. So if the rental cost increases by $30, and then the NOPAT will decrease by this same amount. So it's going to be 216 minus 30. So that will give us 186. And if we put the new level for the NOPAT, 186, and the new level for the NOA, we can calculate the new level for the ROPI, 116. So we just copy the number back. And finally, number 4, increase that for $300, which increases interest expense by $15. notice here, if you change the debt, because debt is not part of the operating assets or operating liabilities, right? It's not operation related. So if you change the debt, it won't impact the NOA. And if you also change the interest expense, because remember, interest expense is not part of the NOPAT either, right? Interest expense. It's not part of the NOPAT. NOPAT actually includes the income which goes to both investors, shareholders, and the creditors. And so that includes the interest expense. And that's why if you increase the interest expense by this amount, it will also not impact the NOPAT. So in this case, actually nothing is affected. The NOPAT still stays at the original level, and the beginning balance of NOA is still 1,500. So yeah, so and then RPI is still 111, right? So it's basically, I just copied the second column number here. So now let me check my answer. Or done correctly.